Excellent. Very good. We are recording, and I'd like to thank everyone for their time in joining us this morning. I am Dave Gambaccini, principal with Xcel Capital Partners in Bedford, New Hampshire, and 2020 president of the New England CCIM Chapter. I'm fortunate to have some CCIM legacy in the room with me today. First, we have Paul Natalizio. I want to point out that Paul is a past chapter president and past chapter board member as well. So that's we thank you for your time and your help with the chapter, Paul. Paul is with Cornerstone Realty Capital. He began his career in 1985 with National Westminster Bank in New York City. Managed multiple commercial real estate banking projects and teams. And in 2002, he left the banking to manage one of the premier privately held real estate firms in Boston. In 2004, Paul founded Cornerstone Realty Capital. And since that time, Cornerstone has become recognized as one of the top commercial broker companies in the marketplace. Every year, Paul and his team place over 125 loans with over 30 individual lenders. And as I said, Paul is a past chapter president and board member. Paul, thank you for joining us today.
Thank you for having me.
Certainly.
Appreciate it.
And Mike Delsesto is also a past chapter president and current board member. And Mike is also the current first regional VP for Region 11, CCIM Region 11. And that region includes New York Metro chapter, Connecticut chapter, and the New England chapter. So once again, we've got some CCIM weight on the call, which is fantastic. Mike is a acquisitions manager for the Mount Vernon Company. And prior to joining the Mount Vernon Company, Mike owned and operated a real estate boutique company which specialized in student housing. And Mike had launched a software company for apartment owners, as well as been an advisor and early an investor in Rent Juice, which was eventually acquired by Zillow. Mike, thank you for your time today.
Thank you, Dave.
Excellent. So listen, we brought you guys together. We had a CoStar multifamily webinar, multifamily trends in New England webinar a couple weeks ago. And we had some great response and feedback from that. And of course they came, they brought that discussion from the economist side of things and let us know what they see. What we wanted to do is kind of bring this locally. You know, Paul, you specialize in multifamily lending. Mike as an acquisitions manager and specialist in multifamily. I thought it made sense to hear from you what you're seeing in the industry. Obviously, we all set out with a plan for 2020 and that all changed, right? February, March, things changed drastically and we're still, you know, amidst this COVID-19 pandemic. So I wanted to have a conversation with you guys locally so we can understand, you know, not all is lost in this. There's a lot of opportunities out there. And I'd like to try to get your perspective on everything from lending programs, the acquisition and disposition side, and any insights you guys can help our audience understand what we're doing to navigate, what you're doing to navigate, and what you see. Paul, I'll start it off with you. You and I have had some conversations recently, and you've got a great overall view of what you see going on right now. And I guess, you know, if you have the ability, can you kind of give us a snapshot of what you're seeing now, right? Where are you seeing things and what is your business seeing in terms of where we were and the impact it's had now and where you kind of see things going? And we'll kind of start there and oh, by the way, I should say that I welcome Q&A. There's a Q&A box at the bottom, and I encourage active participation. I will be able to read these questions, and we will be able to answer them live time. Your microphones and your cameras are muted for the audience, but we will see those questions and try to answer them. So, Paul, I'll turn it over to you.
David, thanks for having me. It's really fun to be on a CCIM webcam event. I thank you for all the work you're doing with CCIM. I was involved many moons ago, and it's a terrific organization. And a lot of the people that I met in CCIM actually helped mold my career and what eventually became Cornerstone. And if any of those are on this call, thank you. And I hope everyone's staying healthy and safe in this environment. I'm going to just start off, give a little bit of history. I mean, it's really not a history. Around here, it all started in March, and kind of how it rolled out world, and then try to give you some perspective of where we think the market is today. So on March 10th, Governor Baker declared a state of emergency, and basically all business in the Commonwealth was brought to a halt. I think that timing is pretty consistent to what happened in all of New England. Excuse me. Hi, I'm working off my phone, and since I am old, I am lousy with technology. So
Right, we got you.
Excuse me, I'm back. You know, acquisition loans we were working on in the marketplace basically came to a halt. Buyers looked to retrade deals or just walked away from deals. One specific deal that we worked on, the buyer walked away, another buyer came in, he walked away. Finally, there's a buyer for that property because that buyer had a 1031 exchange. But the only business that we've seen primarily for acquisitions during this time are people who had 1031 exchanges. A lot of people just walked away because of the uncertainty in the marketplace. Loans in the pipeline that were refinancing just became more difficult to get to the finish line. Banks had to focus on PPP. What many people don't realize is the banks had to use their own capital to make the PPP loans. That's why you may have heard initially, Bank of America said, we will provide 25 billion for PPP loans. They put a limit on it because they had to use their own capital to make those loans. I think a lot of people just thought the Fed was financing all of that, all the PPP loans up front. That's not the case. Actually, there's not a banker in the marketplace that can tell me when they're going to get paid back from the Fed on PPP loans. The lenders were basically all hands on deck, focused on PPP. One example, the president of the bank was spending the weekend putting in the applications. So it became very difficult to communicate with the banks. At the same time, banks were taking a hit to capital in regards to putting out the PPP loans. The banks also had to deal with an outreach from many of their borrowers asking for forbearance on loans, primarily hotels and retail. This took a lot of time for the banks to work through, but the Federal Reserve and other regulators were completely open for the banks to basically give 3 to 6 month, even longer forbearance for these loans and not penalize the banks. As long as a borrower was paying the loan prior to requesting the forbearance, it was pretty much an automatic, no hit to capital, no hit to reserves for the banking community. We saw banks start to, kind of a domino effect hit the marketplace where banks, one group of banks just stopped lending We assume those banks may have had a riskier portfolio or less capital reserves, and those banks just basically pulled in lending and said we are not making new loans. Other banks started to quickly harden credit standards, and I'll talk about that in a few minutes, but loan to values, cash flows, strength of borrowers became more important. We also saw a slow but dramatic shift in spreads and pricing. I want to use an example. We put a loan under application, multifamily loan, straight up, low loan to value. We put that under application on March 17th. That loan closed in April at a 1.98% 10-year fixed rate. On March 26th, which is a little over a week later, we signed a term sheet with the same lender with the same terms for another borrower, another low leverage multifamily deal. During the period between signing the term sheet and closing, the bank rethought its pricing strategy and retraded the loan. The borrower in the end decided to take a 5-year fixed rate deal, but if he had taken the 10-year deal, that loan would have closed at a 3.04% rate. So that same bank, a 9-day difference in timing of signing a term sheet, cost the borrower over a 1% difference in the rate. And we saw that across the board. It was kind of a slow moving train, but it hit everyone eventually, and spreads widened with all the banks, or interest rate floors were imposed by all the lenders. Insurance companies who tend to be more conservative on leverage basically left the market. Their pricing went up substantially, and for a short period, we saw their rates widen to where they really weren't competitive in the marketplace. Another example is we were in the midst of financing a low leverage deal in the marketplace. We had locked in an application in February at 2.95% for 10-year money. As we went through the process, the insurance company was great. They held the rate, but that same deal in April would have priced at 4.25% to 4.5%. The CMBS market basically shut down. And the other organizations, Fannie and Freddie, agency lenders that provide a lot of liquidity to the multifamily market, they continued to lend, but they instituted substantial escrows on loans. Another example, we were in the midst of financing some properties in Malden, Massachusetts. We had 65% loan to value. The new requirements from Fannie on those loans required the borrower at closing to fund 6 months worth of principal and interest payments, plus 1 year of insurance, taxes, and regular repair reserves. It was a substantial amount of money, and that made those lenders a lot less competitive in the marketplace. So this all happened very quickly, major impact marketplace. And where do we stand today? I'll start with agency. Agency pricing has become extremely competitive again. The Fed has pumped significant amount of money into the market and spreads that had been in the high 2s to low 3s, that had shot up into the 5s for a very short period of time, are now back into the high 2s and low 3 range, depending on affordability, depending on location, depending on deal size. There's still significant escrow requirements on agency deals, and but agencies are willing to discuss waivers of those escrows for strong borrowers on lower leverage deals, 65% and lower. The agencies also increase what we call pre-review, where they do basically a deeper dive in supermarkets, in certain markets, nothing affecting the Northeast, but certainly in markets like Las Vegas and Orlando have been a concern for the agencies. The agencies are still concerned about rate collections, and they're looking to August as an indicator of stability in the marketplace right now, because the $600 a month unemployment extra funds that tenants are getting expires on July 31st. Until they see the market itself being able to hold up, versus the government basically propping up funds and helping collections, the agencies are still concerned about the marketplace. The insurance companies have come back into the marketplace more competitively on pricing. On multifamily, the spreads are ranging from about 310 to 350 for 10-year money. They're being more selective. They're focused on collections, and they may increase vacancy in their underwriting in certain markets, and especially if they're looking at student housing. As far as the banks are concerned, there's still a wide range of underwriting and pricing in the marketplace. I'd say most banks have increased their pricing to where the floors are anywhere from 3% to 4% on a 10-year deal. So there's an extremely wide range in the marketplace, depending on the lender and whether you're doing a swap financing or a balance sheet funding. But that's a much bigger spread than we've typically ever seen in the marketplace between lenders. We're still seeing local banks willing to finance construction. One lender said to us, we may prefer construction because the property won't be delivered in 18 months to 24 months and will avoid the COVID issues. We're seeing lenders still willing to finance condominium development with strong borrowers in the marketplace. Banks are very focused on collections right now. Every deal we're financing, the lenders want to do a deep dive into the borrower's entire portfolio, what their collections are on the property that we're financing, but collections across the board, and the client's ability to fund potential vacancy, retail, apartment collections for the foreseeable future. So we're seeing certain markets like Boston, people are very focused on what's going to happen with the schools and what will happen come September. But that's basically an overview of the marketplace. The great thing about New England is we have a lot of banks. Not every marketplace has that luxury. If you go to a market like Florida, where you may find 4 banks in the downtown community, here in Lexington Center, I can walk out the door and touch 10 banks in 2 minutes. So having all the banks in this marketplace, providing a lot of liquidity, there are still banks that are comfortable lending in this environment.
Great. And Mike, on your side, with acquisitions in Mount Vernon, student housing, tougher restrictions and guidelines with underwriting, where are you guys and what are you seeing as, and how has your acquisition strategy changed in light of the COVID-19 pandemic?
Sure. Thanks, Dave. I just want to also thank you for providing such great web-based content during this time. You've really taken us to the next level. I was on the webinar last week with Mark and Todd Galvin for CoStar. I thought that was excellent. And in order to understand how I'm reacting to the current situation, I think it's important to understand just a general approach to an acquisition strategy. So I can kind of walk you through that, and then any specific questions you have about what we're dealing with right now in real time, happy to address that. And you know, you listen to the statistics from guys like Mark or Todd or Paul, all folks who are much smarter than I am. And then you have to figure out how to apply those statistics and how to apply those facts. And, you know, I think everyone has done a really good job, you know, effectively measuring the beginning of the impact of the COVID-19 situation. But it's still difficult to measure, especially with multifamily, because the Boston multifamily market, which is my main focus, is comprised of many mom and pop landlords who may be underrepresented in the data. And this is generally my seller. You know, rarely am I buying from an institution. You know, CoStar's acquisition of apartments.com has made it easier to collect the data, but you know, how do you collect data from a mom and pop landlord who only advertises on Craigslist or through word of mouth? You can't. You know, so I think experience on a local market gives you a significant competitive advantage, especially right now, to be able to talk to the players in the space, to be able to talk to guys like Paul, who, you know, speak to the president of a local bank, you know, on a daily basis. I really think that's the edge that you need right now. You know, you could have a fund based in Manhattan with an analyst who went to Wharton, who, you know, sits there modeling deals all day in Excel, but his pro forma is only as good as the data being inputted into the model. You know, does he understand the local politics? Does he understand the amenities that drive value in that marketplace? You know, has he been to the local brewery that's walkable to the new development that he's modeling and is now shut down? You know, does he understand what's happening locally? And you know, just real quick, back to basics, kind of, you know, CCIM 101 here is, you know, what drives acquisitions is the perceived value to an investor, and it's both today's value and an estimated value in the future. So how do you value a building? It's a multiple of the net income that is generated by that investment. And that multiple generally comes from a capitalization rate. And I know I'm probably telling you all stuff you already know, but I just think it's important to come back to the fundamentals as you look forward to, you know, not only what's happening in the future, but even what's happening now. And, you know, one of the most important drivers of capitalization rates, in my opinion, are interest rates and overall capital market conditions, right? And no one understands capital markets better than Paul Natalizio, which is why I always highly value our conversations together. What's often overlooked in a valuation model is the qualitative data. So that's qualitative as opposed to quantitative. I think the qualitative data is equally as important as quantitative data. And it's the qualitative data that determines in part what the rent rolls are now and in the future. And by understanding the rent rolls, you can understand your NOI. Let's not forget, rents are paid by people, human beings, and what they pay is determined by what they are both willing and able to afford. So willing means that you, as the owner or landlord, deliver value to the tenant relative to other housing options, and they're willing to pay you that rent. Apartments are really the ultimate consumer product, and the marketplace determines what you can charge for that product. What are the tenants willing to pay you? Able to afford it, and this is especially important right now, it means that the tenant can literally afford that rent. A household budget is discretionary, and it's also emotional. The percentage of income that a tenant spends on rent has changed over time. Arguably, rent to income ratios have increased to a dangerous level, and it's important to keep an eye on that. So it's important to understand these qualitative factors that influence what people are willing and able to afford. How do you do that? You talk to people. You go to that local brewery where your tenants hang out and, ask them what's going on. You conduct surveys to understand how to create value for tenants. Fun random fact, in multiple surveys that I've conducted with apartment renters in Boston, an in-unit washer dryer was the most valuable amenity. You may not get that from a economic report. So it's important to understand the people and what's happening in their lives and what's important to them, what drives value for them. So the rent prices are in effect determined by tenants, not landlords. And the best way to predict your rents, both this year and 5 years from now, is to understand your tenants as much as you can. One more thing, as you look at, what's happening right now with values in the marketplace, it's really important to note that it's the buyers, not the sellers, who determine a sales price. So you got to talk to the buyers, understand what's happening in their world, understand what's driving their decision. Say I own a 10-unit building, apartment building in Boston. I list it with a broker today for $5 million. That's my price, $5 million. And, as a seller, I always have a justification for the number I want, but it doesn't matter how much I paid for the building initially, or how much I spent on CapEx, or how I evaluate the comparable sales. The market is driven by the buyers, and it's the buyers that'll ultimately determine the price that I get. And when trying to understand where we are right now in this market, I'm far more interested in talking to buyers versus sellers. Buyers are generally forward-looking, and sellers are generally looking in the rearview mirror. So that said, Dave, given you just kind of an overall background of how our approach works, what specific questions might you have relative to what's going on right now?
Sure, it's come up before, Paul. You mentioned it even in your intro here that student housing is it's curious what's going to happen with education, right? Are they going to open up schools? Are people going to come back? There's obviously a large demographic of students in the Boston area. So from your side, Mike, what do you see as the significance of universities or off-campus student housing as a driver for the Boston multifamily market?
Dave, that's an excellent question. So many of you probably know this, but there's a huge student population in Boston. According to one statistic, 20% of everyone that lives in Boston Metro is a current student. So that's 1 in 5. It's a lot of people. The student population is often overlooked by local policymakers because the students are generally not residents, which means they don't vote. So the politicians care less about what they think. It was a little scary initially, but what I'm seeing now with regard to what's happening with the universities is looking fairly positive. I actually co-own a student brokerage that specializes in BC housing, and we're actually signing leases with that brokerage 16 months in advance. And there's been no hesitation on the part of the student renters and their parents to move forward. So I think, you know, as we look forward a year from now, the expectations will be relatively back to normal. So that's positive. It looks like most of the universities are planning to open and have folks back on campus, which is also positive. I do know that there's going to be a lot of rules and restrictions. And of course, this is a moving target. And once everyone comes back, there's the chance that it could be shut down again. But that's good news, I think, for landlords because, you know, folks are going to move in at least initially, which creates a better situation than having an apartment that no one shows up to. But you know, if the students don't come back, it'll really impact everyone because they occupy so much of the supply. That supply then goes back online and starts competing with the marketplace, and it would really have a significant impact. But right now, it's looking mostly positive, Dave. And you know, I would also point out that as universities look to implement plans for social distancing, you know, that'll require more space, not less. And you know, there's been some preliminary talk with, you know, some local universities actually working with landlords to expand their housing supply so that they can distance their students more effectively.
Right, and you know, there's a slightly different conversation regarding the demand for or the impact to the multifamily housing. With recently, Amazon has come out saying that they're trying to they're acquiring the Blue Cross Blue Shield building down on Dorchester Ave. So they're just south of the Seaport District. So that's a 96,000 square foot facility, and they're going to open this as a last mile distribution warehouse. Granted, they have a lot of automation, but there's obviously going to be the need for new employees there, right? They're going to be bringing people in. So the question is, or I should say, they're going to be hiring folks. Does something like Amazon opening a facility that large in the Boston area, do either Paul or you, Mike, do you see much of an impact in terms of housing for employment reasons? In other words, you know, most of these employees are going to be local. It's not like they're going to bring people outside of that general area. You're likely going to have warehouse workers, drivers, and shipping and packaging. But what kind of impact would something like Amazon have opening, you know, repurposing a Blue Cross Blue Shield building into warehousing? What kind of impact does that have on the housing?
Sure, I can start off. The key indicator that I look at, Dave, is jobs. And I think it's unclear right now how many jobs that project will create and what type of jobs that they'll be. But that's really the number that I would keep an eye on. Secondly, just in terms of overall housing supply, you know, according to everything that I read, there is still not enough inventory of apartment housing, both now and in the pipeline. So, you know, the more competition you have from other types of users, further puts pressure on that existing supply, which drives both rents and values in the marketplace for apartment owners.
Sure. And Paul, is in a slightly different way to that, obviously you can look at Amazon and say, great, they're opening this large facility down near the seaport. But when we look elsewhere in New England, do you see a difference in lending terms based on the location? So something, say, you know, Boston Metro versus New Hampshire. Do you see a difference in those lending terms?
I think we will. I think we are every state is kind of moving along at their own pace, first of all. I was up in Portsmouth a week ago and enjoyed a beautiful day out with people walking around, many without masks, and lounging around restaurants that were had outdoor seating. In Massachusetts, it's a much slower open. In Rhode Island, if I theoretically go to look at a property there, I have to, I guess I'm not supposed to leave the state, or I'm supposed to quarantine for 14 days. So, every state is kind of taking a different approach, which I think with what Mike's saying is going to have an impact on employment or unemployment and so forth. But I think when markets go into this type of environment and a recession, the fittest survive the best. So I think there is a turn for lenders to be more conservative, and the strongest markets are going to benefit more than the weaker markets. And so a Portsmouth, Manchester, and Salem are going to be more desirable to a lender than some of the other communities that lenders may have reached a little bit for in the past, and now will, I believe, underwrite more conservatively. We're seeing the same thing in Boston. Some lenders that are offering maybe some of the better terms out there in regards to rate are focused on where they might have lent at 75% loan to value. That's come down to 65% loan to value. So the market's definitely gotten more conservative. Lenders do have less capital because of PPP. Plus, I'm sure the bankers we've talked to have analyzed the potential risks down the road of some of their portfolio while they provided forbearance for hotels. I think they feel that market without a vaccine is not going to come back for a long time, and there will be some write-downs on their balance sheet, and that has an impact to how they lend on multifamily and where they want to put their capital.
Sure. And what about real estate taxes, Paul? Do you think there's any potential of future increases, or what do you think that impact is going to be regarding the taxes on properties?
Yeah, we think that there's a risk that taxes are going to go up. The states are suffering. There's a real question whether the federal government is going to provide enough of a bailout. I just had something in my town in Bedford, Massachusetts. I received an email yesterday from the superintendent of schools, and it was an interesting discussion of what they're trying to deal with in our town. We're a small town of 14,000 people, and the budget for the school department has to be reduced by $2 million because of tax collections that are not going to occur from monies from the state and also from hotels and other income that the town receives. It's a significant impact to the budgets. And this superintendent said, our town doesn't want to increase taxes right now because a lot of people are hurting and we're in this type of recession. I'm not sure we'll hear that same tune a year from now if collections are still off, we're in a recession, and the town needs money for its employees. We haven't seen furloughs in the state or local governments. And I think there's going to be a lot of pain. And I think some towns or most towns will try to take advantage of raising taxes on larger real estate owners to deal with the shortfall.
Yeah, so maybe not even just specific to multifamily, but in general, a potential risk to tax increases, real estate tax increases.
Yes.
Yeah, okay. Shift a little bit. Mike, with your background and your experience with technology, right? And, you know, granted, there's a lot of uncertainty. We don't know where things are really even now. We're not sure what's to come, but how do you see technology playing a role in shaping either the multifamily market or in general real estate?
Sure, and that's a really broad answer. I'll focus on multifamily, and that's a industry that has always really underutilized technology. You know, with Rent Juice, it was essentially a listing service for apartments, which it was unbelievable that it didn't exist until David Vivero did his, who was the founder, his thesis at HBS, his class project, and came up with this concept. But I think you're just going to see a massive shift where existing technology is now being deployed and adapted for multifamily, and I think it's here to stay. I'm involved with a 3D virtual apartment tour company, and I think that's going to be the way of the future when it comes to you know, touring these assets. And you know, I don't even want to think about what it means for office. You know, if we can all you know, conduct this meeting with however many participants, you know, here on Zoom, you know, is there a need for an office with a conference room? You know, I think what's happened has raised a lot of questions. It's brought about a need for you know, technology to be implemented and quickly. And you know, I think what's most interesting is not what's happening now, but what happens a year from now and how much we're still utilizing this technology in real estate. And my prediction is it'll be a significant change and in many ways an improvement.
Yeah. And I also read recently that, and Paul, this is probably in your wheelhouse. Redgate Capital Partners of Boston just refinanced, and you know, where, you know, as they described, they typically might cash out, but they lined up a $59 million refinance from Fannie Mae, you know, and it's, you know, it's down in across from the Mystic River. I believe it's down that direction. I'm not exactly familiar with that property, but certainly it's, you know, they're showing a large institution like them showing signs of a shift in focus of either their capital, their refinancing, or their overall portfolio management. Do you see that on your level? Do you see it locally where some of these investors that own large properties are changing their approach to managing a portfolio, either refinancing, refi cash out, or are they just holding still on what they have, or what are you seeing there?
First, I want to mention, Mike, it's amazing where technology is going. My son just bought a new game for his VR system, which I played this weekend. It was Star Wars, and I couldn't believe what was happening. I was on a ship, and Darth Vader's in my face, and I'm climbing up ladders, and it was incredible. And I can see myself throwing the VR on and being in an office and being able to see real detail in that office. It was fascinating. I did get dizzy in about a half an hour, but it was fun. It was fun. right now, I'm not seeing a different strategy. We've had some clients look to refinance to take out some liquidity. We've cash out is not a desirable request. Lenders do not want to cash out borrowers. Actually, even the agencies were not looking to cash out borrowers' equity until maybe the last couple of weeks. They've started to consider it in certain circumstances, but the market has not looked favorably on cash out refis right now. Our borrowers have mainly just stayed the course. A lot of them already had some pretty good liquidity. When this happens, they all say, let's look for opportunity with pricing. We'll see where that ends up. And if they do find some opportunities to buy properties at what they might consider a discount to value.
Yeah. Excellent. Well, listen, we're coming up on about 50 minutes. I want to encourage some Q&A. We have a couple questions that I've been receiving. So I'll start asking some of these participant questions to get us going. And once again, type into the Q&A box. There's a little button at the bottom of your screen, and I can read these out. Question from the audience: what are you seeing, hearing from buyers with capital on the sidelines?
That's a great question. I can start off. In terms of what happened and how it happened, it's like we were hit with a natural disaster. I would look at it like multiple tornadoes that just caused chaos. Some were worse than others. And what you're seeing right now is that everything's just kind of stuck in place, and there's really a wait and see approach. And that's on both the buyer side, buyers with cash on the sidelines, and also on the seller side, where, I've got my building that I think is worth $5 million. I'm not lowering my price yet because I first want to see how this plays out. And I don't want to leave money on the table by panic selling. I am seeing, acquisitions that started prior to COVID. The buyers were able to retrade the seller, in the diligence process. And, the seller was so desperate to conclude the transaction that they gave in on those concessions. But I'm not seeing a lot of movement with price. As you all know, a lot of smart investors were starting to stockpile cash before this started, just because, I think there was a mentality that prices had peaked in many markets. So there's a lot of cash on the sidelines. A lot of people are ready to go. It's just right now they've adopted a wait and see approach to see how everything looks when we're on the other side of this. That's what I've been seeing.
And Paul, you may see a little bit more of this. Regarding appraisals, are appraisers changing their approach to appraising multifamily properties?
Not yet. It may be
Really?
coming.
Okay.
I think Mike is spot on where the market is. But if we start to see trades and prices adjust, I think appraisers will adjust. No, I think the appraisers in multifamily have not adjusted. I think they're using sales data that was available previously. They may, some of the larger firms are putting in caveats that this is the value, but under COVID, things are different and more of a CYA comment in their appraisals. But we haven't seen a change in value from appraisers. I think the banks will push back a little bit on looking at vacancy or potential vacancy in collections. But what I'm hearing from the appraisal world and the banking world, no one wants to rock the boat, and the regulators really aren't pushing lenders to be super conservative right now. And I think the appraisers will go along with that. But if we get data showing trades at higher cap rates or lower prices per unit, that will end up funneling into the marketplace at some point. We've been involved, at least I've been involved in 2 acquisitions during this, since COVID. One deal is in kind of the A+ market location. That got retraded at about 4 or 5% adjustment to where it was under agreement pre-COVID. And there's another deal that we're financing, again, about a 6% adjustment to where it was under agreement pre-COVID. But there's just not enough data out there to see that trend yet.
What about credit loss numbers on a percentage basis? What are you seeing?
It's all over the place. In Boston, almost zero impact, and Mike touched on that a little bit. And where we're seeing the most biggest change in collections are communities that are some of the poorer communities, like a Fall River, where collection numbers may be off 5 to 7%, versus other markets where we're hearing collections are as good as they've been pre-COVID.
Yeah. And Mike, you may have a little more insight on this. Are you seeing, or actually either one of you, are you hearing any talk of rezoning of non-residential properties? Also, any condo projects considering a conversion to apartments?
I'll just quickly address your last question because I think it's a good one. I think a lot of owners were holding their breath when the rent collections came due on the 1st of the month, and were very surprised at how good collections were, even with talk of forbearance for tenants. I think people still want to pay their rent because they're expecting to owe it on the other side of this. What I would look out for is once that extra $600 a month ends, and once people start to realize that the jobs they thought they had are no longer available for them to return to, are they still going to pay their rent at that point? So that's what I would look out for. I have heard a lot of talk about rezoning, particularly from hospitality to multifamily. I think it's just too soon to start to see that happen yet. I think first we need to see who makes it and who doesn't, and then on the other side of that will be how to reposition those assets. But it's just too soon to tell how all that will even play out. And so far, I think it's going overall much better than expected.
Sure. What about location of apartments? Are you seeing a flight to suburbs, more interest in versus suburbs instead of downtown or greater Boston?
Yeah, so it's interesting, right? Going back to the technology question, why on earth would someone live in an apartment in the Seaport and pay, $5 a foot for an 800 square foot one bed? One of the primary drivers of that is they can walk to their job at PwC headquarters in 5 minutes versus commuting in from, say, Newton, which could take you over an hour at rush hour. If that employee is no longer required to be in the office 5 days a week, the entire equation changes, and there may be less value in living in core Boston. So I do expect to see more of a shift to markets that are both more affordable and might offer a better quality of life. And I think technology will play a role in that.
And that's on the tenant side, perhaps. Paul, what are you seeing as far as the investor side? Do you think of investors are making a choice on suburban versus downtown?
I think people stay to their knitting. So if some of our clients are more city focused and some are more suburban focused, and I don't see people doing a huge shift immediately. I think Mike is spot on with the potential trend, but if a vaccine is discovered by the end of the year and people feel comfortable going back to work next year, it's still a big question mark. I think most people will, and I think the city will get back to a semi-normal very quickly. It's just uncertain now, timing and when that'll eventually happen.
Sure. Excellent. Well, listen, guys, we're coming up on an hour. Want to respect everyone's time. Thank you to those who have joined us today. We've your insight as local experts. Thrilled to have you on as members of the New England CCIM chapter. Both of you are past presidents. I will send out some contact information for you folks as well to the audience as a follow-up. So if anyone has any questions, I think Mike and Paul would be happy to talk to you directly and advise you if you need it. So with that, let me just take a quick pass. Okay, good. A couple. Okay. So with that, from the New England CCIM chapter, thank you, Paul. Thank you, Mike. Thank you to the audience.
Thank you, David.
Content out. And look, we're all trying to navigate this, and this is certainly great. We're going to try to do a little bit more of these asset specific webcasts just to provide some insight, maybe globally from, let's say, CoStar, and then narrow that focus to what we're seeing in our actual market and those of us with boots on the street. So thank you all. At this time, we'll wrap it up, and hope you guys all have a great week. Thank you.
Thank you, Dave.
Thank you.
Thank you. Good
Take
day.
care.
Bye. We'll see ya. Bye.